Welcome to Hargreaves Lansdown's Meet the Manager. I'm Joseph Hill, and today I'm joined by Shalin Shah, lead manager of the Royal London Corporate Bond Fund, which features on our wealth shortlist of funds selected for their performance potential. So Shalin, the fund invests primarily in investment grade bonds. So what are you looking for in your analysis, and what does the portfolio offer to investors?
Thank you, Joseph. When we look at analysing the corporate bond space, we're looking deep down at fundamental bond analysis. So we're looking at companies first on the level of operational gearing, so the level of fixed costs these companies have. We're looking at the standard credit analysis around the level of gearing in terms of debt they have, and of course the visibility of cash flows. Now, a lot of that is traditional credit analysis, but where we also add value is areas where others aren't looking at much, which is the covenants, the legal language. If in an uncertain world, those cash flows that you think will come through won't come through, you need that protection through covenants, legal language, and what kind of assets we can grab if there is a specific default environment. So that's really how we add value through that research lens. In terms of the fund and what it offers a very attractive investment grade corporate bond yield. So at the moment, you're getting very attractive yields due to the underlying gilts. But in addition, through that stock selection, we're picking up additional yield versus a typical index. But we're doing that in a very risk-controlled manner through that protection and that bottom-up analysis.
And something you've been speaking to investors about is the inefficiency of bond markets. Could you just break that down for us a bit more? So why are bond markets inefficient? And as an active manager, how can you take advantage of that?
Sure. So we believe bond markets are extremely inefficient and have been so for many years. If anything, they've become even more inefficient over the last few years. The first thing I'd say is bond markets have become much more commoditized. So you have a lot of investor money focused mainly on indices, passive as an example, or annuity money that's focused on very simple features around the bonds. When you talk about passive funds, they're focusing mainly on the index. Active managers are also doing that. But when you take a step back and look at what a benchmark is, an index is simply a list of the most indebted companies. Now, if you then look at companies with the largest debts being the highest weight in an index, from our perspective, it's the worst way to start a portfolio of lending decisions. You shouldn't place more money towards the companies with the most debt. So that allows us to take advantage of that inefficiency by looking beyond indices and looking for where there really is value. And also, to get into an index, you need specific features. You need a credit rating of at least BBB-, as well as an issue size of at least 250 million. So we can circumvent that and buy certain bonds which are slightly lower in issue size, but much better spreads because the commoditized lending out there is not looking at those types of bonds. Secondly, the fixation by most investors is credit ratings. There's a lot of delegation to rating agencies for risk assessment. But when you look at a typical credit rating, often it doesn't tell you how much money you get back if there's a default. So if I were to give you two bonds, one with a 90p in the pound recovery, another with a 10p in the pound recovery, we're not going to be indifferent to which we own if it's the same probability of default, same credit rating. But a lot of the market they're just focusing on lending based on ratings. And that brings on security as an attribute being undervalued. So bonds with that extra recovery if there's a default are undervalued. We can access those types of bonds, and they're around 40% plus in the corporate bond fund. We can access that without sacrificing yield. So it's a beautiful approach to actually lending without putting more risk into the funds.
We're now at a very different interest rate environment to a few years ago. Coming out of the pandemic, rates were at those ultra low levels and they've risen significantly since. So how has that affected the companies that you're analysing?
Sure. So the investment grade landscape is mainly made up of very high quality companies with strong balance sheets. So they've weathered the storm quite well, despite that rise, as you say, from 1% gilt yield to over 4.5%, and therefore a higher yield environment. There are some sectors that aren't as lucky. So if you think about the real estate sector, they've been more impacted. And of course, you really do need to do your bottom-up analysis there. We tend to lend on a secured basis, so that does put in a lot more protection versus, say, unsecured within that real estate. But it's not all companies that are impacted in the same way. So those with much higher leverage, much more borrowing, are more impacted in this environment. When you look at other sectors like the banking sector, they actually are making more money in the high interest rate environment because they're able to pass on those costs to the wider economy. So that's where there are different sectors with different outcomes in this environment.
And who would you say has had the biggest influence on you as an investor?
That's a great question. So, of course, you'd remember Jonathan Platt and I co-managed the fund a while ago. So, as leader of the fund and leader of the actual team, I think he had a very strong presence, strong leadership. But in addition, I used to manage money alongside Sajeev Vaid, who helped me hone my skills in terms of looking at relative value across bond structures. And of course, Martin Foden, who's head of credit research, who again has a really strong analytical mindset. So really bringing in lots of different skill sets together, with Jonathan being great at team working and collaboratively, Martin being a great analyst, and Sajeev really teaching me to hone my skills on relative value. So I took the best out of a lot of people as my career developed.
And outside of work, how do you switch off?
So we have a little team badminton going, so I love doing that every week. And then of course I spend a lot of time with the kids. Like to take them out to their activities, mainly as a taxi driver, but it's all good fun.
Great. Shalin, thank you for joining us.
Thank you.